Good morning, everybody. Today is August 7th, 2020. We are about halfway through the third quarter of 2020. 2020, what a year. This is called the stock market versus the economy. Obviously, the stock market has disconnected from the economy. We are also defensive. All of y'all have noticed you own about half as much stocks as you normally do, roughly, most of you. And I have had a lot of calls about two things. One, John, the stock market's going crazy. What are you doing? I own half as much stock as I used to. Two, what the heck is this gold and silver? Lots of calls in the last month. So we're going to go over that. And mainly I want to give you some of the reasons we are defensive now. And we're just going to go over the facts that have driven us to that conclusion. We want to give them to you as quickly as possible. It's a lot of information. Please hang on. Please listen to this. This is an important one. So first, you will understand this better at the end, why I put this on here than you do now, but you will understand it. We are not Japan. We are not Europe. We are America. We are unique in the world because of our Constitution. We are unique because of our founders. We are truly, I believe, the hope of the world, and we will solve our problems. It takes us time. It's very messy, a lot of fussing and fighting, but eventually we do solve our problems. We believe we will get a chance to buy stocks at better prices than what they are today. That's the short and long of it right there. Now, so people have called me in the last month, John, what the heck are you doing? Look at the NASDAQ. We are partying like it's 1999. The NASDAQ closes above 11,000. Sure enough, it did. Now, here's the big drawdown in March. Now, a lot of people seem to have forgotten that in March, I had a lot of calls in March. What the heck? The stock market is going to the bottom. What are you doing? Blah, blah, blah. But it has rallied right back up, just like 1999. Now, 1999, I'd been doing this about 10 years. I was right up in the middle of this, just like a rocket ship prior to 1999. Fed very loose, Y2K, all that. Pumping money straight into the NASDAQ. Stock market, just the NASDAQ, just like a rocket ship. .com bubble. We had the .com bubble in 1999. And unfortunately, it peaked right here in March of 2000. I'm sorry, this is 1999. It peaked in March of 2000. Unfortunately, we then had the .com bust. Now, this is a drawdown of negative 80%. So, yeah, that was tough. I remember that. I was right up in the middle of it. So you had the .com bubble, the .com bust, negative 80% on the NASDAQ. So let's look at these charts. Oh, yeah, I see some sort of resemblance. So, yeah, went through that. Negative 80%. Not fun. Remember that. Left some scar tissue on me. Now, the other thing, John, what the heck is this gold and silver in my account? I went back to 2007, 8, and 9, the great financial crisis, 2008. Gold finally separated from the stock market. At the beginning of 2008, separated from the stock market. We started going through, AIG went broke, Lehman Brothers went broke, Bear Stearns went broke, Merrill Lynch went broke. All those big companies going broke, lots of financial institutions going broke. So the Fed hops in, a raggedy downward motion, negative 45, 50% on the S&P 500, very painful. But gold, look at gold, kind of floating here. And then the Fed really starts to get involved at the end of 2008. And guess what gold does when the Fed starts backing up a lot of debt, issuing paper. Yeah, gold is hard money. Cash is paper money. Hard money, obviously, doing very good. Gold. So we took our first hedge position in gold, and it was just a hedge, a very small position in gold, back in February of this year before all this mess started. Now we've increased that. Started out as a hedge. It's turning into an investment. I fully intend on any relaxation in precious metal prices to round those positions up just a little bit. So, yeah, that's gold. That's gold during the great financial crisis. Tremendous run. So let's see, why are we defensive? Well, this is the initial jobless claims that we printed the other day. Again, this is the great financial crisis of 2008, 2009. Initial jobless claims really spiked. Here's some past recessions, and we are in recession, by the way. But yeah, the great financial crisis. This is what we printed the other day on initial jobless claims. So yeah, makes me defensive. Gross domestic product, the total output of our goods and services of our nation. Again, the great financial crisis of 2008, 2009. This is what we printed the other day. So yeah, that makes me, I get, that gets printed and I get defensive. Gross domestic product, everything we produce in the country. Yeah, not good. Well, this kind of puts it in a longer term perspective. So again, great financial crisis 08, 09. This is early 80s, drawdown, recession. This is right after World War II, big drawdown. This is what we printed the other day, annualized. This is what they expect for 2020. So yeah, you print something like that, and it makes me defensive. So what about Europe? Maybe they're doing a little bit better. No, great financial crisis right here, 2008, 2009. This is what we printed the other day in Europe. Yeah, no, that's not good. So yeah, but John, the stock market's good. Yeah, look, here's Microsoft, Apple, Amazon, Google, Facebook, Visa, MasterCard, Nvidia, Netflix, and Adobe. Let's look at those guys. Drawdown in March, pretty hard drawdown. Fed gets involved. Look, boom, just motorboating, baby, just racing. Since the low at the end of March, just a race for these 10 stocks. But look at the other 490 stocks. We're still down. We're still negative. That gives me great pause when just a few stocks are going up. Now, this is even more concentrated. You got the big five, the FANG stocks, Facebook, Apple, Netflix, Google. Everybody's heard of FANG, big five. The big five versus the other 495 stocks in the S&P 500 index, stock index. Look at the big five, big drawdown. This is the other 495 stocks in that index. Big drawdown, motorboating, baby. Roll it. Up 50% since the low. What about the other 495 companies? What have their stocks done? The other 495 companies, not so good. That concerns me, that there's so much concentration in the stock market. Some of these companies value of some of these big companies is larger than a lot of countries, and some pretty big countries too. So that gives me great pause. Again, .com bubble, .com bust. I don't know. I don't know what's going to happen. There are some differences between then and now, namely the Fed. But let's see what earnings did. Maybe there's a reason. No, earnings were down 37%. Stock market in March down about 35% or 40, 30, 35, 40%, depending on what index you use to measure the stock market. S&P 500 earnings, they were down 37%. That gives us pause, makes me pause. That's not good. That is not good. So what happened? Why did everything go up? This is our supply of money. This is controlled by the Fed. The Fed can print money. It can increase the amount of money in the economy. It can decrease the amount of money in the economy. Now, this is the great financial crisis. Again, it took them a little while during the great financial crisis to get that money printer set up and printing. Actually, it's just all typed in on a computer, actually. They don't really print it. It's not paper money, but this is a supply of money. You can see they started increasing it during the great financial crisis. Baby, we are on steroids now. They are creating money. Well, we've never seen this, frankly. It's beyond anything we've ever seen. Printed money. So you might call this paper money. So what did we buy? Well, we bought gold and silver, hard money. So that money goes, in essence, it takes one loop, but it ends up in bank reserves. So this is bank deposits, excess reserves at the Fed. So the Fed creates the money and it goes straight back, goes to the bank, goes from the bank straight back to the Fed. Wow. Now you can see now prior to this, the movement in this excess reserves on deposit at the Fed was so little that you can't see it. But oh wait, same thing. Now this time, see, they got about halfway through that recession before they started cutting on the money printer. They got on this one early. Now you can see this gray bar, we are in a recession, so that's the start of the recession. They immediately cut on the money printer. So they are printing money. I mean, that makes this look little. So a lot of money printing going on, which goes to the bank and then straight back to the Fed. So what does the Fed do? This is the assets that the Fed owns. 2008, again, about halfway through, they finally start buying debt. They bought mortgages. They bought all kind of debt. They are doing it on steroids now. In fact, they're not only buying mortgages and things like that. They're buying corporate debt, junk bond debt, municipal bond debt, which is anyway, we'll talk about that. So the Fed is buying the biggest bonds, like when you buy a bond fund or a bond ETF or just straight up buy a bond, the Fed is in there buying these bonds. They announced a program whereby they would start buying corporate bonds. Then they announced that they were going to start buying what we call junk bonds. That's the big companies that have a low credit score. So they announced they're going to buy those too. Then they announced they're going to buy municipal bonds like the state of Mississippi, or City of Chicago was the first one to line up in this line to get money from the Fed. Fed gave them City of Chicago issued $1.4 billion in debt, and the Fed bought it. The Fed's buying the first bond they bought. The first debt they bought was City of Chicago, $1.4 billion. Now, Jay Powell, who runs the Fed, says he is not going to buy stocks. Now, they've said that. The Japanese are already buying stocks in their economy. They've been doing that for quite some time. We'll talk about that in just a second, too. And here's an interview with a retired hedge fund manager. He's like, oh, yeah, they're going to buy stocks. You know, they say they're not going to buy stocks, but yeah, the Fed's going to start buying private companies. Our government is going to start buying corporations. Now, I got a problem with that. When your government starts buying your companies, I got a problem with that. So the Fed, when they started backstopping all this debt out in the private market, that pushed prices up for that debt, for corporate debt and junk bond debt, junk corporate debt. And it made, it also gave the green light to these companies, even the junky ones, to go out and borrow more money. So they were already over leveraged in a lot of cases. But since the Fed's going to buy their debt, maybe they went and borrowed even more. And I don't know that you would tell your child to do that. Hey, honey, you've borrowed way too much money. So, hey, interest rates are down. Let's just go borrow some more. That's what they're doing. So what happened to bond prices? Now, as some of y'all remember, we sold a lot of corporate debt back here in February. This goes back to the 1st of February, that's Feb, through the end of March. So this captures the 35% drawdown in the stock market. The COVID crisis hits. What happens to the prices of debt? These are the biggest. This is the biggest. This blue line right here, this first one, this color, is the biggest corporate bond fund in America, corporate debt. Now you can see that we're rocking along. Now I sold a bunch of that corporate debt back here in February, rocking along, and COVID hits. Already too much debt out there, and it drops the prices. Prices of those bonds went down 5%. Now look, if you're getting 4 or 5, 6% on a corporate bond fund and it drops 5% in price, well, you know, that makes for an unpleasant conversation. because you've just lost a year's worth of interest. Now this lighter blue line right here, municipals, that's municipal bonds. That's the light blue line. Well, municipal bonds went down almost 10% in value during March. What the heck? Municipal bonds are considered very safe. What the heck? Well, we get into a crisis and people start going, man, this state is broke. They've got gigantic unfunded pension liabilities, and people start worrying about that in a crisis. A lot of these states are broke, in essence, because they've got gigantic unfunded pension liabilities that we are somehow going to have to solve that over the next 10 to 20 years. So it made the price of municipal bonds go down, almost 10%. Now, this is junk bonds that the Fed has decided they're going to buy. Again, just trading around. The junk bond market, pretty sensitive, maybe sensing something's wrong here. Too much debt out there, too much junk debt out there. Look, they went down over 20% during March, during COVID. So junk bonds went way down. They really got hit because people really start to worry about getting their money back. You know, you buy the bond, you're loaning them money, you start worrying about getting your money back. They went down about 23, 24%. Now, this is the biggest junk bond fund in America, run by BlackRock. And coincidentally, guess who the Fed hired to manage their junk bond purchases? Well, that'd be BlackRock, which is a big conflict of interest, if you ask me, but nobody asked me. So, but anyway, a lot of people raised their eyebrows when the Fed hired BlackRock to manage their junk bond purchases. So, you know, during the crisis in March, when the stock market went down around 35%, bonds started going down too. Bonds went down too, because it was perceived as a very deep threat to the economy. It blew basically a 30% hole in our economy during that period of time. So, but look, they started rallying. Now, this one started rallying earliest because the Fed announced, hey, we're going to buy these companies' bonds. We're going to buy these companies' debts. This is municipal bonds. Hey, we're going to buy municipal bonds. Again, City of Chicago got right up there in line first for a $1.4 billion municipal bond issue. So, hey, look, Fed's backing everything up. Fed's going to back up the prices of all this stuff. They're going to own all this stuff. Junk bonds. Then the Fed, a little bit later, says, hey, we're going to buy junk bonds too. Low-grade corporate debt. So, yeah. Government stepping in and going, we're going to buy all that. So, this was quite shocking when they announced they were going to buy junk bonds. And Mohammed El-Arian is somebody I follow. And he says the pledge to support junk bonds. Of course, a lot of people are shocked at that. Could create zombie companies, and of course we think that's exactly what will happen. So he's sending out a warning, hey, you may want to think about that. And we've talked about zombie companies and zombie economies before. When there's excess debt and the government steps in and starts buying all of it, it creates a zombie situation. This is the Japanese Hang Seng Index. Japanese index, and the Japanese have already crossed the Rubicon, and they are buying stocks as well as all the debt. So their government is right there in the stock and bond market of Japan, buying up, owning private companies and owning the debt of private companies and owning the stock of private companies. So let's look, does that in fact zombify a country's economy? Well, this goes back 20 years to 2000. This is the Hang Seng Stock Index. So the Hang Seng Stock Index has roughly made 45% over the last 20 years. So 45% over 20 years, that's about 2% a year. Yes, in fact, that's about inflation. So their stock market is about kept up with inflation. That, in fact, is a zombie market. So lots of people, you'll see this word zombie going forward. Are we creating a zombie economy? It takes all the dynamism out of your economy when governments step in and start owning everything. So now you know why we say we are not Japan, we are not Europe, we are America, we are unique, we will solve our problems in this, I think we're different. Now, we are following the Japanese path, but I think at a certain point we will stop doing that, and we will solve our problems. Now, it's very messy. It's very people fussing and fighting. We believe we will get a chance to buy stocks at better prices. That's what we think. That's why you don't own as many stocks right now as you normally do, because we think we'll get a chance to buy them at better prices. We think at some point the government will take a step back, maybe this fall, maybe this winter, and prices will relax, I think. Maybe after the election, I have no idea. But we think there's a fair chance in the next 6 months that the government may take a step back and go, we just cannot own everything. And in fact, we don't want the government to own everything. So we think we'll get a better chance to buy stocks and bonds coming up in the next few months. Now, if you want anything or need anything or want to talk about any of this, please give us a call. Thank you so much. We appreciate your patience with us and hanging tough with us. We are in safety mode. We don't mind being in safety mode for a little while. These things cause us to pause, cause us to sort of reassess and think about what we may need to do. And right now, we are just in safety mode. Thanks so much.